Over the last 2 decades, the total return of publicly traded U.S. REITs has been remarkably similar to the S&P 500, all while paying out consistent income. For many, the dream of passive income is tied to the image of owning a rental property, collecting a rent check each month. This ideal, however, often clashes with a much harsher reality. The late-night phone calls about a broken water heater, the stress of finding reliable tenants, and the endless cycle of repairs and maintenance can turn a passive investment into a demanding part-time job. This common experience raises a fundamental question for anyone seeking financial independence. Is there a better, more hands-off way to earn income from real estate? The appeal of rental properties is understandable. They are tangible assets you can see and touch. They offer the potential for steady cash flow and long-term appreciation. Many successful investors have built significant wealth through a portfolio of rental homes. Yet the path is littered with challenges that are often downplayed. The time, effort, and specialized knowledge required to be a successful landlord are substantial. For every story of a landlord relaxing on a beach funded by rental checks, there are countless others of investors overwhelmed by unexpected costs, difficult tenants, and the sheer operational burden of property management. This is where the conversation turns to an alternative. Real estate investment trusts, or REITs. These instruments offer a way to invest in a broad portfolio of income-producing properties, without ever having to screen a tenant or fix a leaky faucet. They are designed to provide investors with a share of the income generated by large-scale real estate, such as apartment complexes, shopping malls, and office buildings. For the investor who values their time and wants a truly passive income stream, the question becomes critical. Can REITs effectively replace the traditional rental property as the cornerstone of a real estate income strategy? The goal is not to declare one method universally superior to the other. Instead, it is to provide a clear-eyed comparison for the typical small investor. We will explore how these two approaches stack up against each other on the metrics that matter most: cash flow, effort, risk, and overall costs. By understanding the distinct advantages and disadvantages of both landlording and REIT investing, you can make a more informed decision that aligns with your financial goals, your risk tolerance, and, most importantly, the lifestyle you wish to lead. The journey to passive income should not come at the cost of your peace of mind. At its core, a real estate investment trust, or REIT, is a company that owns, operates, finances, income-producing real estate. Think of it as a mutual fund for real estate properties. Instead of buying a single rental house, you are buying shares in a company that owns hundreds or even thousands of properties. Sprawling apartment communities, modern industrial warehouses, busy retail centers, high-rise office buildings. This lets everyday investors access large-scale commercial real estate profits. The defining feature of a REIT is its legal obligation to distribute the vast majority of its profits to shareholders. By law, a REIT must pay out at least 90% of its taxable income in the form of dividends. That rule makes REITs popular with income-focused investors. The company acts as a pass-through, collecting rent from many tenants, then distributing that income directly to investors. This creates a steady, predictable dividend stream, passive income without landlord headaches. The most common choice for individuals are publicly traded equity REITs. They are listed on major stock exchanges and trade like shares of Apple or Google. You can buy them through a standard brokerage account or inside retirement accounts, IRA, 401k. Contrast that with buying a property, mortgages, inspections, lengthy closing processes. With a REIT, you can become a real estate investor in minutes. Immediate diversification. A single rental home concentrates risk in one property and one geographic location. If your tenant leaves or the local job market weakens, your income can drop to zero overnight. A REIT spreads that risk across a vast portfolio. An apartment REIT might own properties in dozens of cities, so a vacancy in one building barely moves the needle. That diversification gives safety and stability hard for individual landlords to replicate. Let's break down the financial realities with a simple example. Imagine you have $50,000 in cash to invest. Option 1. Use it as a 20% down payment on a $250,000 rental house. You secure a mortgage and find a tenant paying $2,200 per month. That's $26,400 per year on paper. But net cash flow is very different. Subtract the monthly mortgage payment. Subtract property taxes. Subtract homeowner's insurance. Budget for maintenance and repairs. Account for potential vacancies. After expenses, net cash flow might be about $300 per month, $3,600 per year. That's a 7.2% cash-on-cash return on your $50,000. That doesn't include your time managing the property, or the risk of a major unexpected repair, like a new roof. Many new landlords learn that advertised rent does not equal take-home pay. Option 2. Invest the same $50,000 into a publicly traded REIT. The REIT pays a 5% dividend yield. That generates $2,500 per year. Dividends are deposited to your brokerage, usually quarterly, no extra work. No mortgages to manage. No property taxes to pay directly. No repair bills. REIT management fees are already baked into performance. So $2,500 versus $3,600. But it's not just about dollars. REIT income is truly passive. Rental income requires active management. REIT shares are liquid. You can sell in days for cash. Selling a rental takes months and costs. Agent commissions can be about 6% of the sale price. The most significant yet often overlooked difference between owning rentals and owning REITs is the impact on your lifestyle. Being a landlord is an active endeavor. Property manager, marketer, handyman, customer service representative, advertising the property, screening applicants, handling legal paperwork, collecting rent, responding to maintenance requests at any hour. Even if you hire a property manager, which typically costs 8 to 12% of the monthly rent, you are still the ultimate decision maker, approving major repairs and dealing with escalations. This commitment of time and mental energy is the opposite of passive. REITs are designed for passivity. Once you purchase the shares, your work is essentially done. Property acquisition, tenant relations, maintenance, capital improvements. Your only responsibility is to monitor your investment like any other stock or fund. Risk profiles also diverge significantly. With a rental property, your risk is highly concentrated. A single bad tenant who damages the property or refuses to pay rent can be financially devastating. A local economic downturn could lead to extended vacancies and falling property values. In contrast, a REIT diversifies that risk for you. A large residential REIT may own tens of thousands of apartment units across the country. A single vacancy or problem tenant is a statistical rounding error with no noticeable impact on your dividend income. While REIT share prices can be volatile and fall with the broader stock market, the underlying income stream from thousands of rent payments is generally more stable. Finally, consider the element of freedom and liquidity. Owning physical real estate ties you down. It is an illiquid asset that cannot be easily converted to cash. The process of selling a home is slow, expensive, and uncertain. This can limit your financial flexibility. Publicly traded REITs offer complete liquidity. You can sell your shares on any day the market is open and access your capital quickly. Getting started with REITs is straightforward and accessible to almost any investor. The easiest way to begin is by purchasing shares through a standard brokerage account, the same kind you would use to buy stocks. You can choose to invest in individual REIT stocks or a REIT exchange-traded fund, ETF. An ETF holds a basket of dozens or even hundreds of different REITs. That gives you broad exposure to the entire sector with a single purchase. For most beginners, a diversified REIT ETF is the simplest and safest starting point. When evaluating a specific REIT, there are a few key metrics to consider. The most obvious is the dividend yield, the annual dividend per share divided by the stock's current price. While a high yield can be attractive, it is not the only factor. Ensure the dividend is sustainable. To do this, investors look at funds from operations, or FFO. FFO is a measure of a REIT's cash flow. The payout ratio, the percentage of FFO paid as dividends, shows the cushion. Below 80% is generally healthier. You should also consider the REIT's property sector: apartments, industrial warehouses, data centers, retail malls, healthcare facilities. Each has different drivers and risks. Industrial REITs have benefited from e-commerce, while retail REITs have faced challenges. Finally, check debt levels and review the management team's track record. Here is a simple list of the main advantages and disadvantages to keep in mind. Pros: high liquidity. Pros: low initial investment. Pros: true passive income. Pros: instant diversification. Cons: stock market volatility. Cons: no direct control. Cons: dividend taxation. Cons: no tax depreciation benefits. For the typical investor seeking a simple, low-effort path to earning passive income from real estate, REITs present a compelling and powerful alternative to traditional landlording. While direct ownership offers greater control and some tax advantages, it demands a significant investment of time, capital, and hands-on effort. It is an active business, not a passive investment. The constant demands of property management can erode the freedom passive income is supposed to create. For many, mailbox money becomes a second job. REITs deliver on the promise of passive income. They let you collect a share of rent from a diversified portfolio without dealing with tenants. Barriers to entry are low. You can start with a small amount and build over time. Publicly traded REITs are liquid, offering flexibility physical real estate can't match. You give up direct control and some tax perks, but you gain simplicity, diversification, and most importantly, your time. My recommendation: begin with REITs as a foundational real estate holding. They offer income, growth potential, and ease of ownership. A diversified REIT ETF can provide stable dividends and broad exposure. This lets you learn the market and enjoy property-based income without landlord risk. It's not a compromise. It's a strategic, more manageable passive approach. Ready to act? It's simple. Open a brokerage account. Research a broad market REIT ETF. Look up tickers like VNQ or SCHH. Check the fund's holdings. Check the expense ratio. Check the historical dividend yield. Consider a small initial investment you're comfortable with. Learn by doing, watch how it behaves, and experience dividend income without landlord duties. From there, keep learning and adjust as your portfolio and your confidence grow.